Do mergers and acquisitions really improve the competitive position of companies and help to sustain their value in the market? If yes, how so?
Okay, I would say that they do, and they do this through the achievement of synergies. So, in simple terms, synergy is simply the extra value that two businesses stand to gain when they come together in a merger, as opposed to what they would have gained if they were operating as two separate businesses. So, it's just like when you say 1 + 1 is equals to 3, as opposed to 2. So, synergy is that extra value that a merger brings to the table. And there are two distinct places where potential synergy lie. It could come from revenue growth and could also come from cost savings. So for the revenue growth angle, this can be achieved from the increased capacity that a merger brings to a combined entity. Having a larger company also gives most companies a stronger market presence. So this helps them to grow their revenue base through the combination of marketing efforts. If there are similar products, that could be cross-selling. And there's also the wider product base. And then on the cost savings angle, you have the elimination of duplicate roles, and then they're able to streamline operational expenses towards having a stronger competitive advantage. So with this advantage, they're able to set prices in the market, and they could bring the prices lower than their peers because of their strong market presence, and this in turn gives them the synergy and improves their value. I would say that in the past few years, Nigeria has seen a lot of impressive M&As, just like the Access and Diamond merger that was earlier spoken about. We saw Access Bank coming to the table with their strong corporate banking focus, whereas Diamond Bank was bringing their retail experience to the table. So combining both helped to form a stronger, formidable entity, and they are now better placed to succeed in their industry. So yes, mergers do help improve the value of companies.
Thank you so much. Thank you so much for your contribution. Mr. Omowale, I was calling you to tell us how the capital market is likely to evolve in light of the pandemic, and what would be the likely implications of mergers and acquisitions.
Okay, so the thing is that everything is interwoven. To be able to understand how the capital markets will evolve, we need to also look at how the businesses will evolve, because at the end of the day, what is the capital market? The capital market is just a tool that businesses use to raise funding, to run and grow their operations. So you agree with me that at the start of the year, most companies were filled with lots of optimism. They had lots of capital expenditure plans, expansion plans, but then the pandemic came, and then a lot of these plans have been changed, and now most companies are just trying to stay afloat. Well, on the flip side, some large corporations and even the federal government have taken advantage of the current situation in the economy, which is the low yield environment, to restructure some of their expensive loans because interest rates are at a very low level now. So the debt capital markets is really the place to be for companies looking to raise capital. And that has helped large companies. But then the smaller companies and companies in industries which were already in a precarious position before the pandemic, the story hasn't been so good for them. So the pandemic has further exacerbated their troubles, and now they're in even more of a debilitating state, because such companies would find it very difficult to access capital with their subpar performance. In pricing debt instruments, investors look at the risk inherent in these companies, and the higher your rate, the risk of the business environment, the more expensive such securities would be. So we advise such companies to look towards more patient capital, like private equity or equity from strategic investors, which is where M&As come in. So another thing about the current economic situation is that a lot of companies now have relatively low valuations, and this is a good time for financial investors to come in. As was mentioned, private equity investors are the most aggressive at this time, particularly as it relates to M&As. So they're typically looking to buy low and sell high. So with companies at low valuations at the moment, this is the time to swoop in and take advantage of mergers and acquisitions.
Thank you very much. Thank you. Ms. Omowale, I was calling you to describe the willingness of the financial institutions to provide debt financing for mergers and acquisition transactions, and what should companies do or know to be eligible for these facilities?
Okay, so I would say that it's worthy to note that the recent moral suasion by the CBN has really improved the willingness of financial institutions, especially commercial banks, to support the real sector. We've seen that the current data shows that there's been a larger amount appropriated to private sector credits than earlier periods. So that's all well and good. But then regarding them financing mergers, that's a totally different ballgame. It's a bit different because in financing a merger or an acquisition transaction, the risks inherent are a lot more than a regular term loan or a regular bank loan, because now you have to consider not just the risk of the entities, the risk of their business environment, but then there's also the elephant in the room, which is the risk of their consolidation. So financing such a transaction would just be equivalent to financing a new business. And everyone knows how risky it is providing finance to a new business. There are lots of things that could go wrong with the merger, just like Mr. Badeja had highlighted. So the banks would factor all of this in arriving at the pricing for such a loan. Another thing that they would consider is the fact that the outlay that is required for an acquisition is usually a large amount, and the repayment tenure would likely be a medium to long-term one. So things like the single obligor limit that is imposed by the central bank will also be a factor in play here. So all in all, it would be a really expensive debt that might have to be taken on by a consortium of banks and not just one bank. So that would then evolve into a syndicated loan transaction. While that is not impossible to get, it will just be largely expensive. So that is why we would advise that companies, especially at this time with the low yield environment, to resort to the capital market instead. Instead of going to the banks, it might be more effective or efficient to go through the capital market in raising financing for an acquisition at this time.
Thank you so much. Thank you so much, Omowale. Omowale, I do have another question for you, if you do not mind. I'd like you to assist us with the notable post-mergers and acquisition factors that can lead to economic recovery.
Sorry, I didn't know I was muted. So, yes, as mentioned earlier, the true success to a merger lies in its post-merger phase. So all of the work that has been done pre-merger, during the merger, is not even half as important as what is done after the merger is concluded, because that is what leads to the true success of the marriage. So I would say that the three crucial factors that are important for the success of any merger would be strategic planning, ardent implementation of set plans, and regular monitoring and evaluation. So regarding the strategic planning aspect, before going into any marriage or any agreement, people would have their reasons, right? So these reasons, the synergies they have in mind to attain, all of this should form their strategic focus. And when you have a focus and you're able to articulate your goals and objectives, it's then easier to have a workable strategic plan. But then all good plans are flexible. They shouldn't be cast in stone. It should be a plan that is susceptible to change. So as the combined entity goes along, they should be able to learn from the day-to-day running of the bigger business and be able to apply this to their initially set strategic plan. And this will ensure much bigger success. But then all of these plans are nothing if there is no ardent implementation. So in implementing such a plan, the tasks and responsibilities should be appropriately allocated to the requisite officers, and then there should be regular checks and balances to ensure that everyone is on the same page. But the most important thing still with this structure would be cultural integration. So culture has been one of the top reasons for M&A failure the world over. So prior to the post-M&A phase, there should have been plans to culturally integrate the staff of both entities. This is very important in ensuring that the execution of the strategic plan goes seamlessly. Then lastly would be the monitoring and evaluation. So there's a common misconception that this only happens at the end of a period, be it like a month or a week or a quarter or a year. Everyone mostly does like monthly performance review, quarterly, annual. While all of that is good, what is better is having an ongoing system of evaluation. So this helps to check all form of red flags and anything that could potentially be a risk before it occurs. So this is also very key in ensuring success post-merger position for any company. While I wouldn't say that the success of a merger is directly related to economic recovery, it could really help, like Mr. Bade just said, it could be a significant contributing factor, because a successful merger would lead to a high-performing entity, and then a high-performing entity would attract capital. It would lead to creation of more jobs, and in terms of consumption, a larger entity can set prices, and if the prices are much lower in an economy like Nigeria, where there's reduced disposable income, such an entity would be able to offer goods and services at prices that are more accessible to most consumers. So that in itself would increase spending power of people and bolster economic recovery eventually. Yeah.
Thank you so much. I'm trying to manage the time and the questions that we do have here.